everybody. Brian Lockett here with Comprehensive Wealth Management. I want to take you through our market update. Now, the name of our market update this time around is the same as last time around in May because really not much has changed. We are definitely still in the midst of the tug of war that I talked about last time. We're going to go through a current market overview. I'm going to take you through for the case for recession again, take you through the case for no recession, and then I'm going to talk about, well, what do we do about it? So if I had to look at the 4 economic seasons, I would say we are in the slowdown phase. Hard to make a case that we're seeing much in the way of expansion, and I would definitely say we're not seeing enough bad news yet to say we're in a recession yet either. So when we look at our forecasting models, we would describe the current setup as a hurricane warning. Based on history of similar conditions in the past, when we get this level, extreme level of valuations, investor greed, that behavior there is everybody's over on one side of the trade, that being heavy in stocks, and we have this inverted yield curve and high rates, that has been a recipe for trouble, at least in the past. That doesn't mean it's necessarily going to happen, but that's why we are calling this a hurricane warning. Now, when we look at valuations, normally you're used to us talking about the market cap to GDP, so I thought I'd bring a different chart out. This is known as the Shiller PE, Shiller price to earnings ratio. And Professor Shiller got a Nobel Prize in economics for his work here. What you're looking at is a price to earnings ratio of the S&P 500 going all the way back to 1870. And what you'll see here is one, our average is 17. Currently, we're at 35, so we're over twice the average in the price relative to earnings measurement. And there are only two other markets in that time period that ever went above where we're at. And that's not good company. Here's the tech bubble in the late 90s, early 2000s. We know how that story ends. And here's the top of the market, late 21, and we know what happened in 22. There are lots of different ways to put a price tag on companies. You can use the forward price to earnings, trailing price to earnings, 5-year normalized, blah, blah, blah. You get the idea. You'll see here there's a pattern. Expensive or very expensive with the exception of one. The fairly valued, it's the equity risk premium for BAA corporate bond yields. I've never seen that particular metric used. But in the 22 years I've been doing this, I've never seen so many different metrics all saying the same thing. So let's go through the case for a recession. So Morgan actually put this together using AI. And what he wanted was, I want to have a bad economy, shadowed by big spending and AI. And that's essentially what we're seeing. We've got bad economic data, but it's being masked by the government spending. We are spending so much money on government, not programs right now. We have the infrastructure deal, we have the CHIPS Act, and we have the Inflation Reduction Act. It's almost as if we're at war and a massive recession in the government spending. So that's obvious, we think, is masking a lot of this. And then over on the other side, we have the AI buzz. AI has really come on. It's created a lot of buzz. We have a few companies this year carrying the entire stock market. So in our opinion, that's really masking or hiding a lot of the bad economic data that I'm going to take you through. The first piece we have to address, I call it the canaries in the coal mine. What we're looking at here is the inverted yield curve. If you were to take the interest rate on the 10-year Treasury bond, that's considered long-term rates, and subtract the interest rate on the 3-month or the 2-year Treasuries, you should have a positive spread. I should get paid more interest on a 10-year than I do on a 3-month or a 2-year. But periodically, it inverts. I get paid more in the short term than the long term. And every single time that has happened, since at least 1970, a recession has followed. So if you look at this chart here, every time the blue or red line goes below the black line, that's an inversion. And you'll notice that after those lines come above it, then you get the vertical gray bar. Those are recessions. There is without exception. That is the pattern. So this is a big deal. This is something that we have to give a lot of weighting to. And you can see here that we are working on uninverting here. It's going to be a while, it looks like, but still headed that way. The problem is that we are now at one of the longest inverted yield curve in history. And history, unfortunately, is not friendly. If you look, it was 1929, 1974, and 2008 were the other times where we had 500 days or more of inversion. And where I believe on June 30th, it will be 589 days. It is June 28th right now. So we're at 587 days, I guess. All 3 of those markets dropped over 50%. I don't say that to scare you, but it is definitely something that we want to keep in mind. Now, talking about some of the statistics, what we're seeing right now is there's been a surprise in the economic data coming in to the downside. And so basically, this is a whole bunch of different economic indicators that are coming in. They generally get a consensus as to what people are expecting and then what it ends up being. And we're continuing to see a decline in expectations versus reality. So this is not a good trend. Trucking, which is a forward-looking indicator. When the economy is good and the consumer's buying, trucking is booming. Like you look during COVID, trucking was booming. But then COVID stopped. We all went back to work. During COVID, we bought all those things that we, needed new washers and dryers and vehicles and all the other stuff. Trucking is now dropping off because the orders are just not as much. So this is said to be a forward-looking indicator. As you can see here, trucking is dropping off, and you'll notice in the past, whenever you get those drop-offs, those gray bars appear again. Those are recessions. Retail sales are starting to take a hit a little bit here too. In fact, retail sales are now down for the year of 2024. So this is basically saying that the consumer is either struggling or they have everything they need. But if you're a retailer and consumers aren't buying your stuff, that's going to definitely hurt your earnings. Now, we think it's because the excess savings has been spent. During COVID, again, we were sent home and we were sent a bunch of cash. You look at this personal savings rate, it absolutely exploded. And it dropped and then exploded again with the second round of stimulus. And then it's been coming down ever since. And what we're looking at here now is that we're seeing an actual negative savings rate. And it's because inflation has really beat up on people. The higher cost of living and the higher cost of borrowing is resulting in people having to put more and more money on the credit card. We are now looking at record credit card levels in terms of total balance nationwide, and the rates are ugly. You're looking here, blue are large banks, green are small banks. You're looking anywhere from 28.5% on the high side in terms of rate to 15.25% on the lower end. Either way, it's expensive. If you're a struggling consumer and you get behind on the credit card, it's going to be really tough to climb out from under that. That is going to affect consumption. No surprise, as a result, we are seeing credit cards rising, and it's skewing towards the younger generation. Same with auto loans, rising and skewing towards that younger generation as well. And it doesn't look like there's any relief in sight for a little while. So the May headline CPI Consumer Price Index is at 3.3%. The Fed's target is 2%. So we got a ways to go. Now, just this week, I don't have a chart for it yet. It came in at 2.6%. So that's some positive sign here that maybe we do have a little relief in the future. But the Fed has said they want to see it down 2% or less. Of course, we'll see. The Fed does not want to repeat history that occurred in the 70s and the early 80s. What we saw, this is the headline inflation, let's just call it. You saw it surge during the oil embargo. They raised interest rates. Okay, they got it under control only to have it come roaring back. To put that in perspective, at the very top, this was June of 81, was the very last rate hike. Prime rate topped out at 21.5%. Today it's 8.5%. So you can imagine the pain that the economy would feel if we were to have to raise prime rate to 21.5% like we did then. So the Fed is likely, at least in our hypothesis, is going to hold rates higher for longer instead of having to give the relief with the risk of inflation coming surging back. So now let's go into the case for no recession. Maybe we get this soft landing. So investor sentiment is bullish, and it's really around AI. Everyone is very, very excited about what's going on with AI. In fact, we have one company, NVIDIA, that's basically carrying the entire stock market right now, and I'm sure half of you are out there. Who is NVIDIA? They kind of came out of left field. They're a graphics card maker. But this is good. This creates that bullish sentiment that can keep things going. As people are feeling good, the economy has a tendency to do well. The Fed's probability of recession is actually dropping. They have their own indicator. Now, keep in mind that the inverted yield curve, this would buck that trend. If this were to we pull off a soft landing, we don't get a recession, even though we had an inverted yield curve, that'd be the first time since at least 1970. Manufacturing and services are recovering. You can see here this trend. We're coming up on that 50 line. Below 50 is contraction, above 50 is expansion. And you can see services dipped into contraction here and then came back out. So this is a positive sign that really the consumer isn't struggling as much as we thought. Economic data overseas is improving. You can see some real lows. This was in our opinion, the shock and awe from the extremely fast rate hiking cycles that we saw by all the central banks to combat the inflation that hit in 2022. And it looks like we're kind of climbing out of that now. So that's a positive trend. There are a lot of jobs open right now. Now, last time I showed this back in May, it was 9 million. So we have seen 1 million jobs drop off of being available, but we still have 8 million jobs available. That's a lot of jobs that people can have. And unemployment is still really low. However, it is rising a little bit. So last time we did this, it was right here, if you can see my cursor, and it has come up just a little bit, that red line. So that direction does matter, but it doesn't matter yet. It's not enough to really care about, but it's something we definitely want to keep our eye on. And by the way, low unemployment is also good for investor sentiment as well. People feel comfortable, they're not going to lose their job. Now, some argue that maybe we already had our recession, right? We had an inverted yield curve, and in 2022, global manufacturing went into contraction territory. Now, we haven't been given the official it was a recession yet. There's only one organization that gets to do that, the National Economic Bureau of Economic Research. So anyway, typically what we like to see is 2 negative quarters of GDP in a row, manufacturing and services both in contraction as well. Those are generally the things that we're going to call a recession, but everyone has their own definition. We are seeing some relief interest rate wise overseas and to the north. Canada cut their central bank interest rate by 1/4 point, and so did the European Central Bank. So they're getting some relief there. Inflation has come down enough for them to be able to do that. So that's a positive sign. And this could be good for stocks. If the Fed has, how do I put this? When rate cuts don't cause a recession in the following 12 months, which is we're coming up on, we're really, really close. Historically, that has been good for stocks because a lot of time the Fed is cutting rates in response to something bad. So if they end up, having to raise rates to combat inflation and they're able to let the air out of the balloon slowly, doesn't trigger a recession, stocks have benefited on average 21%, 8% for bonds. However, if they raise interest rates real fast and then we get a popping and they have to cut interest rates real fast because they overhyped, that's been historically bad for stocks, still decent for bonds. Now, everyone got really excited about the possibility of rate cuts this year. So the Fed paused for the 3rd time in a row, November of last year. And the market just got super excited about this. And it rallied hard through the end of the year, rallied strong into the early part of this year. And it was on the expectation that we were going to see a rate cut as soon as March, and in most cases, actually May. Well, then we had 2 upticks in inflation earlier this year, back to back. And it was like, okay, well, we can't cut rates. We don't want to repeat that 70s nightmare. That would be a real problem. So we've actually seen them, roll back the idea of it. And I think the market's now pricing in just 1 rate cut. So everyone was banking on the average of 10.5 months from the last hike last increase to the first cut. And it looks like we're going to be going to the longer end of 14.5 to 18 months. So what do we do about this? If you watched the video last time, it's pretty much the same, though we are going to talk about something called liquid alternatives. Kind of like a stock, kind of like a bond, sits in the middle. So when we look at valuations, prices, valuation is really, really important when you're starting out. And we also want to look at starting yield when we're looking at bonds. So if you look at the price to earnings ratio on the Schiller S&P 500 price to earnings formula, when we're greater than 27, which right now we are at 35, historically you're looking at less than a 2% return. So if I were to go buy the S&P 500 based on history and hold it for the next 10 years, when the price to earnings ratio is that 35 and above, I can expect to make, on average, less than 2% per year. And it's likely because we're seeing a massive drawdown in there at some point, which is killing our average. Now, jumping over here to treasury bonds, what you can see here is when we're in the 4 to 5% range, so your starting yield right now, I think we're at 4.23% on the 10-year treasury, I can expect, if I were to buy it today, based on that, based on history, actually going back to 1820 in this case, I can expect to make about 3.5% per year on average. Not exciting, but I can tell you, if history is any guide, you're not going to take the ride down that stocks are likely going to deliver in that 10 years. Now, something else is sort of the case for bonds is that historically, yield curve inversions are good for bonds. So looking at the 07 scenario, because in terms of yield, it's very similar, and we know now that starting yield matters, the 10-year here was at 4.5%, 4.55%. So in the next 24 months, it ended up being about 22% total return, and over 60 months or 5 years, you're looking at about 47% total return. So not bad. This is one of those scenarios where bonds benefit. Recessions are also good historically for bonds. Wasn't that funny that inversions, which have preceded every recession, has been good for bonds, and then here recessions end up being good for bonds. Long-term and intermediate bonds, you're looking at 10% and a 9.3% per year average for bonds during recessions, at least since 1972. That's a nice little return. Now, I didn't talk about this last time. Liquid alternatives, this is kind of a happy medium here. What you're looking at here on the left, this is the standard deviation or volatility of the category. And over here on the right is the beta or correlation with the overall stock market. How much does it track the overall market? So looking at standard deviation, the red boxes are around the things we're in right now. Market neutral strategy, multi-strategy, U.S. investment grade bonds. That right now, that would be U.S. Treasury bonds, intermediate Treasury bonds in particular that we're in, and managed futures. The volatility of these categories are relatively low. And over here, when you look at the beta, you're looking at a pretty low beta or correlation. So if I have a beta of 0.14, if the S&P 500 went up 10%, I would expect to go up 1.4%. So it's really, really low correlation with the overall market. And it's by design. Really, the strategy here for our active strategies is income in lieu of growth. For our wealth accumulator model, which I'm going to talk about later, it's not responding to this information. So each one of these strategies, the risk-adjusted model, the global allocation model, and the tactical allocation model are active strategies where we're making changes. And the amount of change or response to this is based on the strategy itself. The risk-adjusted model is going to be the most responsive, and the tactical allocation model among our active is going to be the least responsive in this. So when we look at our various models, our active models, we're on the defensive side of this. And when we look at the micro, you can see here, this is a lot of the liquid alternatives that I talked about earlier. So we do have treasury bonds, intermediate in particular, managed futures, multi-strategy, market neutral, and something called master limited partnerships and utilities. Think of that as energy infrastructure. Generally, it pays income more than anything else. Now, looking at our wealth accumulator models, I like to think these are pedal to the metal, your models. It's just head down, you got a long time, you're making regular contributions, and you can just ride through this. The perspective you are taking in those particular strategy or models is this is just short-term noise in a long-term plan. So if you are in those wealth accumulator models, I want to set the expectation. We're not going to be moving around based on what's going on right now. So if we do get that sell-off, it's going to sell off with it, with the expectation that it will recover. Markets expand over time. Now, if you'd like to learn more, if you have questions or want to dive into this deeper, give us a call. You can visit us on the website. And by the way, you can sign up for our newsletter at cwm.com/blog. And with that, I really appreciate you attending today. We're always happy to help at Comprehensive Wealth Management.